All right, so let's begin. Yesterday, we had our last few moments speaking about sustainable income and the fact that sometimes companies have things that happen during the year that are not going to repeat in future. So you've got things like discontinued operations, or you've got gains or losses, things of that nature that are specific to a particular period or a particular year. And so, as I said before, they are, users of the financial statements that are particularly concerned with trying to understand what level of income will continue for the company in the future, which is also referred to as sustainable income. And in order to figure that out, we have an additional, I guess, piece that gets added on to the income statement. And that's where we separate out things like discontinued operations that to show it separately so that someone would easily be able to see what it relates to and what the impact of those discontinued operations are on the financial statements. Furthermore, we also said yesterday that there's something called comprehensive income. So this relates to items that never see the light of day in the income statement. Had the accounting rules been different, they probably would have gone through the income statement, but instead they go straight into stockholders' equity. And as a result, those items are kind of buried in stockholders' equity. And for the sake of, I guess, usefulness and transparency in the financial statements, we are actually required to show those items separately in a statement of comprehensive income. So that's kind of the 30,000 foot view of something that we already discussed at length at the end of yesterday's call. So what I plan to do now is take you through example 3, and I'll just share my screen with you. So, sorry, let me take you through example 3 here in the notes. It's just taken straight out of the textbook, just to kind of give an idea of how we would create a partial statement of comprehensive income. And then the way this is going to go after this, I'll give you guys some time, maybe 5 to 10 minutes. You'll go onto Blackboard. I just before the class, I put 2 extra questions there for practice. One is related to the statement of comprehensive income, and the other one is a fairly big practice question for all the different ratios. So let's look at this question, and we'll do it together. And then after this, I'll walk you through the extra examples. I'm not sure how we'll go today. It's possible that we won't necessarily fill the entire 2 hours, which is quite fine. But I'll stick around. If we do have time left over, I can stick around in case people have questions about the test and so on. As we kind of head to the end of the semester, I normally try to front load the work as much as possible so that as we get to the last few classes, we are a little bit lighter. And, next week we'll just spend time reviewing concepts and trying to figure out what's on, well, not, I know what's on the final, but me walking you through what's on the final. All right, so example 3. In its proposed 2017 income statement, Rabbit Corporation reports income before income taxes of $500,000. So that's obviously a line on the income statement that comes, a few lines before net income. The income taxes are 100,000. Excuse me. And this is not including unusual items. And remember yesterday in the notes, we said that these unusual items are the things that we kind of, show separately because they are not going to repeat. What this statement over here means is that any unusual items, for instance, this discontinued operation, the tax is shown uh, or is netted out of these numbers and not included in just the normal income tax for, for the operations of the company. So they're saying when you show these unusual items in the income statement, you have to show them less tax, right? We would call it net of tax. So loss on operation of discontinued music division. So do you see here how it says operation? So this means it's the loss that they made, basically just from revenue and expenses in that music division. So the day-to-day operations resulted in a $60,000 loss. This again is a discontinued operation, so it will be shown on its own separate line. Then they sold the music division, and it appears that there was a gain on the sale. So whatever assets and things related to the music division were sold for a gain of 40,000, and these numbers are before any tax impact. And unrealized loss on available for sale securities of 150,000. So available for sale securities, I'm not going to go into this too much. It's from chapter 16 in the book, but we don't cover investments, which is chapter 16. Because you'll do it in intermediate accounting too. So you don't really, I'll tell you what this relates to, but you don't really have to be too bothered by it. You kind of at this point just need to know where to position it on the statement of comprehensive income. So an available for sale security is maybe a type of, it could be some type of bond, some type of debt investment that the company made, and any gains or losses on this investment don't go through the income statement, they go straight into equity. And that's what I was talking about when I said there are some items that relate to shareholders' equity alone, and we have to show them so that people can understand that this gain or loss went to equity and did not come into the income statement at all. The income tax rate is 20%. We could have guessed that from this relationship over here, that's 20%. Prepare a correct statement of comprehensive income, beginning with income before income taxes. So there's a lot of information going on here. There's a lot happening. I'll repeat, and I've said this many times, but I'll just keep saying it, that for things like this, sorry, I'm not sure what just happened there. For things like this, you don't, you should know how to formulate the answer, but you don't have to memorize a whole statement of comprehensive income. Remember, you can look in the book or look, on an example that we did or whatever to be able to figure it out. Does that mean you don't need to study for a test or for the final? Obviously not. For all intents and purposes, these exams are open book, meaning you have access to your papers and your book and so on, because I can't, be at your house checking what you're doing. But I would caution you that when something is open book, sometimes people think that, oh, well, I'll just take the time to find the answer as I go through. Your best bet is to make sure that you actually practice and study, and then still have these items to support you as you answer the questions. All right, so that's my little spiel. I'll stop now. So this is example 3. We'll do it together. So name of the company, sorry. Right, as is the case with financial statements, you name the company, name of the statement. It seems that there isn't, if I check correctly, there's no, well, it says 2017, so maybe we'll just do December 31st. So this is the statement of comprehensive income, and it's partial, just so you know, and it's for, because it's showing everything over a period of time, I'll just assume that it's December 31. It just says 2017 in the question, but I'll assume December 31. So those are just the headings. And it says to prepare starting with income before income taxes. So that's where I'll start. So income, so you're basically arranging, right? arranging these items in the appropriate format, which is why I said you just practice and then have the stuff ready. So income before income taxes, then you've of course got the income tax expense, which has already been calculated for you. You can write this as a negative number if you want to, but you don't have to, all right? And then after this is because we have a discontinued operation in this question, normally we would call this net income, but because we have the discontinued operation, we have to call this income from continuing operations, right? To warn the person who's reading that something is coming, right? And now we say discontinued. Stop me if I'm going too fast. Discontinued operations. So this is kind of like a heading now that you have. And what we're trying to organize now is to show this loss on operations and the gain on disposal. So I'm just going to give myself a little bit more space to write because this is going to be a long thing. So loss from operation. I don't know, as the semester wears on, my typing seems to be getting worse. Loss from operations of music division. And you're going to tell the reader that it is net of income tax, all right? So if the loss, I'll come back here in a second, if the loss is 60,000 and tax is 20%, then it must mean that the amount of tax is 12,000. Net of 12,000 income, tax, in this case, savings. Because you made a loss, you actually end up saving some money on your taxes because a loss is tax deductible. Questions on this piece over here? All right, now you go for the gain from disposal of the music division. So this is not from operations, it's the whole thing, right? Net of, and because it's a $40,000 gain, it's going to be 8,000. In this case, it's not a tax saving, it's just net of 8,000 in taxes. So it's 32,000. Right, again, this number was 60,000. Now it's 48,000. The loss has been reduced because of the fact that you can claim tax on it. The gain is also reduced, but for a different reason. It's reduced because you have to pay taxes on it. Okay, so both of the numbers get smaller, but for different reasons. We're not saying that we have to pay tax on a loss. We're just saying that the loss is smaller because of the tax. So remember, the loss is negative, right? And if it helps you, you can put it in brackets. The loss is negative and the gain is positive. So this number is going to be negative, right? And I'm just showing it. Let me just do this and take away the, okay, it doesn't seem like I'm gonna get this thing to obey me. So, so you don't need a dollar sign here. I just don't want to waste time trying to fix that. So you're going to subtract 16,000 from 400,000, which is going to give you 384,000. And this number is net income. Okay, so that's the number that the income statement usually ends on, is now after all this information about the discontinued operations. And maybe it helps if we do that so that you can see that there's a separation there. Now, after we end on net income, we still, if we look at the question, there's still stuff that we haven't dealt with, specifically the unrealized loss on available for sale securities of 150,000. So this unrealized loss is part of, I'll just show you here in the notes again. Remember we said there are some items called other comprehensive income items. So the way we show this is we are going to write other comprehensive income. This is still part, maybe I should move this up because it's still part of the same thing. So other comprehensive income. And yeah, if you just put loss on available for sale, that's fine. But I'm just writing it the way it would normally be written out in practice and the way the book writes it. So this is an unrealized loss, holding loss of available for sale securities. And again, this number was shown pre-tax. So, sorry, let me just go down. This number was shown pre-tax, so you still have to take the tax impact out. 20% on 150,000 is 30,000. So it's net of 30,000 income tax. In this case, again, savings, right? Because the loss is getting smaller because you can deduct it from your taxable income. So you're saving on tax. And then you have what we call comprehensive income. Oops, sorry. And so this is a loss again. You got to be careful. Maybe it's better to put it in parentheses. So it's 384 minus 120. So 264 is the final answer for comprehensive income. So someone looking at this whole situation might look at might have looked at something like 264 and say, oh, that's what this company can generate, but then you would be ignoring the fact that this discontinued operation, or even looking at net income, it looks like your net income is 384,000, but in fact the income that you're able to sustain from your continuing operations is going to be this 400,000. You wouldn't necessarily have this loss with the investment every year. So that's not sustainable. If we just lumped everything together and got to net income of 264,000, then our circumstances look way worse than what they actually are. All right, questions? Yeah. I'm just trying to do it like that. So I know some people like to take pictures and things, just in case. All right, so I'm not hearing any questions. I guess that might mean that either there are questions and you don't want to say, or that there aren't any. So let me move this thing up, and then I'm just going to talk about what we'll do now. So I'm going to give you guys, let's say, maybe 7 to 10 minutes to get into Blackboard and to go to today's Zoom call information. And I've prepared 2 pages there. Both of these come from the textbook. So if you have the textbook, the ratio question is problem 18.2a, and the statement of comprehensive income is actually a practice problem in chapter 18. So let me just show you how to actually move it to the student view so that I'm sure to look at the right thing. So you can download the questions from Blackboard. This is just, in case people don't want to actually go back into the book. But here's the practice problem that I pasted onto Blackboard. So if you go into your Wiley, it's in chapter 18, just under practice problem. It's asking you to prepare a statement of comprehensive income for the year. I'll read it through with everybody. And then if you go to the end of chapter homework material, the problems, set A, the other question that we're doing is this one, P18.2a. So you can either go here to Blackboard and get the questions, or you can look at them in your in your book. It's going to be the same thing. So let me just go into my downloads here for a second. Sorry, this is maybe not as good as just opening this piece. All right. So this is what you should be seeing when you download the first one, and then the second one I put as a PDF. I'm going to give you until, let's say, 11:02 to just get everything together, whether it be on Blackboard or in the book. And then once we come back at 11:02, I'll take a few minutes to read through this question, and then I'm going to ask you guys to try and do it, attempt it on your own, and obviously I'll go over it with you afterwards. So I'm going to step away here for like 2 minutes, give you a chance to get the questions, and then I'll be back.
You said that we do the exercise 18.2, right? No.
Did I miss a question? No. All right, so hopefully that was enough time to get the documents or to get into your book. Remember, I don't know if anybody maybe stepped away and is back now. Remember, the information is right here on this on Blackboard, the Zoom call for today. So I'm just gonna read through this question and then just talk through how you would attempt it, and at that point, I guess, make sure that that everybody is clear. All right. So it's asking for a statement of comprehensive income. So it's basically what we were doing before, except that you will actually do an income statement at the top as well. Remember, for our example that we just did, the statement of comprehensive income started with income before income taxes, but normally it would start with the sales number. So, so in this one, they've given you the full, full revenue, expenses, gains, and losses. Now you may say, well, I don't feel like doing this right now, because what does this have to do with the chapter? Remember that in chapter 14, we learned about income statements and how to do them. And we will need to know that information for the final exam. So, you have the events and transactions of Diva Corporation for the year ending December 31st, 2020, resulted in the following data. You've got cost of goods sold, net sales, other expenses and losses, other revenues and gains, selling and administrative expenses, income from operations of the plastics division. Okay, so that sounds like maybe this is a discontinued operation, so we'll check. Gain from disposal of the plastics division. Again, sounds kind of like what we were just doing here with this music division. And then unrealized loss on available for sale securities sounds exactly like what we were doing earlier. And analysis reveals the following: all items are before the applicable income tax rate of 30%. So you would have to calculate your taxes for all of this stuff. The plastics division was sold on July the 1st, so that does in fact mean that it was discontinued. So you'll have to treat it accordingly. And all operating data for the plastics, division have been segregated. That's just talking about this operations number. The 70,000 is not included in any of these other numbers. Prepare a statement of comprehensive income for the year. So if you go into, let me just see if I can help you guys out here. Just one second. So if you go into the textbook in 18.1, you can see it basically gives you, the statement of comprehensive income, starting with, in our case, for our question, it's net sales, but it's basically the same thing as sales revenue. So you can use this as a guide of how to get to income from continuing operations. And then from there, you're using this information that we had over here to get you through the discontinued operations and get to comprehensive income. Questions, anybody, anything that's unclear before I give you some time to do this? All right, so I'm not hearing anybody, any dissenters or anybody freaking out. So what I'm gonna do is leave this piece up on my screen so that you at least have guidance on how to begin the statement. I think someone, I don't know if it's someone who was on the call before, but I think someone just joined. If you just joined, we're doing this practice problem that's on the Zoom call materials on Blackboard. And I'm just going to leave this up so that you guys can use this. Let's say that we'll check back in 20 minutes, okay? 11:26. I'm going to be right here. So if you have questions, so as not to disturb others, maybe just type them in the chat window and I'll get back to you. So again, you're doing the practice problem. If you are looking at the practice problem in the textbook, just try not to look at any solutions and just try to do this yourself using the template. All right. So 20 minutes. All right, so we've had 20 minutes. It seems that people are either going okay or maybe not either done or haven't started yet. No one's asked me any questions. I'll throw the floor open again. Does anybody have a question before I go over the solution with you? All right. So let's go through it. I've read the question already, so we're just looking at the solution here. And if you ever want to refer back to it, like I said, it's the practice problem in your textbook. So Diva Corporation, name of the company, name of the statement for the year ended December 31st, 2020. You start with your sales number. Excuse me, so it's net sales 4.4 million. Cost of goods sold is 2.6 million. To give you a gross profit, remember the cost of goods sold is obviously an expense that's being deducted. So that gets you to 1.8 million. First, you have kind of the normal operating expenses of the company that will be deducted. So that's 1.1 million of selling and administrative expenses to get you to income from operations. Again, the income from the day-to-day activities of the company, what's sustainable, right? 700,000. Then you bring in the other revenues and gains, 5,600. This should, if you somehow still remember the work from chapter 14, this should be somewhat familiar. Other expenses and losses, 9,600. So you'll add the gains and revenue to the 700,000 and subtract the expenses and losses, and the result is income before income taxes of 696,000. All right, so at that point, you have to calculate income tax expense. Remember, the question said that it's 30% for income taxes. So you say 30% of 696,000 is 208,800 for income tax. So you subtract that from the income before income taxes to get to not net income, but income from continuing operations. Remember, for the previous example, we started over here at income before income taxes, but this is the entire rest of the income statement above it. So you get to income from continuing operations, 487,200. Then you have to show the discontinued operations. And as the question said, they had income from the plastics division, right, from the operations of 70,000. Remember, 30% tax has to be applied to that. So the income would be net of 21,000 income taxes. So it's 49,000 in income. And then there was the gain on disposal of the division of 500,000. Once again, you have to net 30% tax. So it's 150,000 in income tax. 350,000 is the gain net of tax. So these amounts are shown net of tax because how we would say it in practice is they're shown below the line. This is the line that I'm referring to. So income tax expense was already calculated over here on the continuing operations. So anything that comes after this line has to be shown net of tax because we're not calculating income tax again. All right, so that's why we net the tax. So you've got an income and a gain. So these two numbers are going to be added together. They're both positive. You add them to the income from continuing operations to actually finally get to your net income number, right? 886,200. And then the question also spoke about a loss on available for sale securities. Once again, this has to be net of tax because we're below the line. So unrealized loss on available for sale securities, net of $18,000 in income tax. It's savings because it's a loss. So the loss is reduced to 42,000 because it's a loss you deducted from net income. So your final answer is 844,200, and that is called comprehensive income. This item over here is what goes straight into equity and doesn't actually go into the income statement. So this is why we show it separately over here so that people will know that had this number gone to the income statement, the income from continuing operations would have been lower by $42,000. Questions, anybody? Any sign of life? Are we okay here? Do I need to repeat something? Am I talking to myself? All right. So that's the comprehensive income question. You do have a question for comprehensive income in your homework for this chapter. I think it's the last question in the lineup of questions for homework. So you know, you have the support here in the textbook to show you how to do it. You also have the example that we did together. And, you know, in the reading 18.1, there's also another example of how to do a statement of comprehensive income. So I think at this point, people should be fairly okay with doing it, unless there's something that someone wants to ask me now. So with that in mind, let's change gears here to you can either open this in your text or download it from Blackboard, but this is problem 18.2a. I'll go into the problem from here. And so what this is I'm just drilling you on being able to calculate ratios, all right? I know that we did ratios together in class, but remember, I was doing all the calculations and you guys were just following along. So unlike, with the other chapters, we haven't yet had a chance where I throw a problem at you and you sit and do the calculations and see if you can actually get to the correct answers. I know on its face, these ratios look very obvious and it's like, oh, well, I just use the formula and plug my answer into, or plug the numbers into a formula, but sometimes there are extra steps and things that people forget about. So please consider this to be a good exercise of just firming up to make sure excuse me, to calculate the ratios. So it says that the comparative statements of Warburg Company are presented here. So they have an income statement. This looks familiar, right? This is what we were just doing, basically. They have an income statement with net income. They have balance sheets, right? 2 years worth of balance sheets with all the numbers that go into the balance sheet. And then they say all sales were on account. That tells you that they were all credit sales. So if you're doing ratios like accounts receivable turnover and days in accounts receivable, you can use this entire sales number in your calculation because you know that they were all on account. There were no cash sales. Net cash provided by operating activities for 2020 was $220,000. So this is a number that would have come out of a statement of cash flows. They didn't reproduce the entire statement of cash flows. They're just giving you this information. Capital expenditures were $136,000. So those of you who remember Chapter 17 well, you'll now start to suspect that you probably have to calculate the free cash flow, right? And cash dividends were $70,000. Compute the following ratios for 2020. So you start with some of the profitability ratios, then you move into some liquidity ratios, and then you've got your solvency, and then you also have, there we have it, right, free cash flow at the end. So what I want to do now is similar to the question we just finished, and I'm, again, I'm not sitting with you at your home. I'm not necessarily, I don't know what people are doing, but I hope that you will take this time now. I'll give you a significant amount of time to work through these ratios and make sure that you actually understand how to calculate them. Otherwise, we end up with a situation where people have seen me do the work and they may not be as well versed in it. And remember, the homework for chapter 18 is due fairly soon. Not just that, chapter 18 is also on the final, but we wouldn't have had a test on it before. So I'm going to, though, start by just clarifying something for earnings per share. You may remember that earnings per share, in fact, let me just go back to, and you can mostly use these formulas that I gave you already when you're doing the calculation. So earnings per share is calculated as net income minus any preferred dividend divided by the weighted average common shares that are outstanding for the company. So in this question, we're trying to see if they gave us the shares. We know what net income is. It's right here, right? But did they give us, the number of shares? And you can see they did not. Nowhere does it tell you the number of shares. However, they do tell you that common stock is $290,000 and that the shares have a $5 par value. So can anybody guess how we might be able to get to the number of shares?
Divided by 5.
Yeah. So I mean, it seems fairly obvious, but I just don't want people to get stuck on the first question. So if the amount so if common stock, right, I'm just going to do it here because some of us are more visual learners. So if common stock is 290,000 and it's a $5, this is from like chapter 13, right? It's a $5 par. I'm asking what is the number, right? Sorry. What is the number of shares? Let's say more speed. So you're going to say 290 divided by 5, right? 58,000. It's a $290,000 divided by $5 per share. So it should be 58,000. I don't think they're averaging the 2 years. I can double check now and let you know. But this is how you would get to a number of shares. Let me just double check that they're not doing something even more ridiculous, like trying to average both years. Just bear with me for 1 second. Yeah, they do. Of course they do. So they're averaging both years. When I'm saying both years, I mean, let me just go back into the share. Yeah, so when I'm saying both years, they want you to calculate the number of shares for 2020 and the number of shares for 2019 and average them out as the weighted average number of shares. I don't know if I necessarily agree with that, because weighted average number of shares is normally the shares for a particular year, but I guess that's the approach that the book is choosing to take. So 300,000 is the other. So this is the number of shares for 2020. So what is the number of shares now for 2019? And so we're going to go with 300,000. 300,000 divided by 5. All right, 300. And so to average, and this is as a reminder to everybody, for any average that you're doing for these formulas, the average is going to be, you remember this from last week, it's the beginning balance, right, plus the ending balance divided by 2. That's how we calculate it. So yeah, we've got the 60,000, which I guess the ending balance for 2019 is the beginning balance for 2020. So maybe they're not that crazy with doing this. So you take the beginning balance, which is ending balance 2019, ending balance for 2020, and you divide it by 2. So for earnings per share, the weighted average number of shares to use in the calculation is 59,000 shares. Questions, please. Anybody? Why did I just do that? Are you following? Are you sleeping? Are you okay? Talk to me. All right, so it's the great silence. Okay, so 59,000. So going back to this question, when you do the earnings per share, you know what net income is, and I just calculated for you how to get the number of shares. And that same number of shares is what you're using for return on, well, no, actually, you don't have to use it for return on common stockholders' equity. You can just add the two stockholders' equity together. All right, so you're set up to do all these ratios. Like I said, use the book for formulas, or you can use the formulas in the notes over here. It doesn't really matter. They basically amount to the same thing. This is going to be a fairly lengthy business because it's a lot of ratios that you have to calculate. So I would say I'm going to give you 30 minutes, and then check in after 30 minutes. Let me just see. So it's 12. Yeah, let's say 35 minutes. 35 minutes. I'll check in after 35 minutes. You may still need some extra time at that point. And again, the whole purpose of doing this is just so that you can be sure that you know how to calculate these things, since every time we calculated it, I was doing the work. All right. So any questions or point of clarification before we start? All right. If you don't have the book, the question is up here on Zoom call materials. It's 11:42. We'll count 35 minutes from here. And again, as I said before, please feel free to ask me questions in the chat window, and I'll come back around 17 past 12. All right. So I'm here, and good luck. All right, so it's 12:20, and time to go over the solution for this problem. Hopefully you've had enough time to at least go through most of it, if not all of it. I will share my screen and go into the question and then the solution one by one. So we've read the questions. I'm not going to do that again. Starting with earnings per share. As previously discussed, we had to average out the beginning and ending share amounts, which were previously calculated. I showed you how to calculate that by dividing the dollar amount of common stock by the par value. The net income for the year was 218,000. You divide that by the number of shares, that gives you $3.69 per share as the earnings per share. Please stop me if there are any questions. All right, return on common stockholders' equity. I don't know what's the best way here to organize this thing. All right, so you've got your net income, 218,000, and then at the bottom, remember the formula is the average common stockholders equity. So looking at the question, you can see that stockholders equity is these two numbers, 603,400 and 465,400. So those are the numbers that you average out to get to 534,400, and 218 divided by that 534 gives you 40.8%. Does that look right? Why does that look weird? Okay. I'm sure the number's right. I don't know why the math just looked off to me. Yeah, it is 40.8. So it's a pretty big return for the company, 40.8%. They're just rounding to one decimal, which is fine. Again, please ask if you have questions. I think these things are fairly obvious, but just in case. All right, return on assets. So your still return, again, is implying a percentage. You're taking the net income and you're dividing it by the average total assets. So if we look here, total assets, 1,026,852,000. So those two numbers add together, divide by 2, gives you 939,850. The numerator is your net income. So you should have had a return of assets of approximately 23.2%. The next number that or ratio that we're dealing with is the current ratio. So the current ratio is the current assets and current liabilities that are involved. So over here, you can see that you were given a total for current assets and you were also given a total for current liabilities. So you didn't have to add anything up. So there you've got your 377,900. Let me just go back and show. So that's current assets divided by 203,500. So it's 1.86 to 1. So for every dollar of liabilities, the company has $1.86 of current assets. And normally we're aiming for at least 2 to 1. So they're kind of okay. They're almost there. Accounts receivable turnover. So where do these numbers come from? You remember, you want to look at the formula. It's this net credit sales divided by the average accounts receivable. Average always means the beginning balance plus the ending balance divided by 2. If we go to the question, your sales for 2020 over there, remember the question said they're all credit. So you can take this entire number and then you take the two accounts receivable balances and you average them out. So you add them together and divide by 2. That should have come to 110,300 as the average accounts receivable. The sales at the top divided by that average accounts receivable, 17.1 times. That's a very high turnover. Remember, we want this number to be as high as possible. And you can see based on the average collection period in days 365 divided by this number that you just got on top, they collect their receivables every 21.3 days, which by normal accounts would be a pretty quick collection, because normally people have about 30 days or 45 days to pay. So this is good management of accounts receivable. Remember, current ratio, accounts receivable ratios, and inventory ratios are all part of the liquidity analysis. So the next thing is inventory turnover. So how does that go? Remember, it's cost of goods sold divided by the average inventory. So to find cost of goods sold, you got to go back up again to the income statement. There's the cost of goods sold. Your average inventory is these two numbers together divided by 2. So there's the average comes out to 120,750. Cost of goods sold 105,8540. So it's 8.8 times, right? That's the how many times over in the period they sold their average inventory. And then to get to days in inventory, the formula is just 365 divided by the inventory turnover. So this tells us that the company sells, or let's put it the other way around, that a piece of inventory, whatever it may be, is on the shelf for approximately 41.5 days. And that's talking about the entire inventory. So if the inventory consists of different products, this is an average of all of those products. So if it was like a Walmart, they've got some things that will expire within 30 days and other things that are going to be, okay, even if they're on the shelf for a year. So, if you were the inventory manager, you'd probably want to look deeper into the different categories of inventory to see how they move. But nevertheless, inventory is on the shelf for 41.5 days. Then we come to times interest earned. This is a solvency ratio, and we covered this yesterday, right? So you're talking about your net income before income tax and before interest, right? Divided by your interest expense. That's how you calculate times interest earned. So so over here, they take this 310. So the question is, where did that come from? So income before income taxes is 310,002. That they add the interest expense, right? That's how they get to, sorry, let me just positions. That's how they get to these top numbers, and then the bottom number is the interest expense. So 15.1 times, that means that the company can pay its interest expense 15 times over with the income before income tax and before interest. So if you were a banker looking at this number, you'd probably be fairly pleased, saying, well, this company probably won't have much of an issue paying interest if I loan them some money. Asset turnover is the net sales divided by the average total assets. We already did average total assets on top here when we did the return. Just go back. When we did the return on assets, that was with net income. The asset turnover is with the sales number. So sales divided by the average assets, 2.01 times. So you're saying that for every dollar you've invested, right, on average in assets, you were able to generate $2 of sales. That's basically the way to think about it. Your assets turned over 2 times a year to generate the sales that you did, which is a little bit of a weird way to think about it. That's why I just say, think of it as, for every dollar invested in assets, you've got about $2 of, or for every average dollar invested in assets, you've got $2 of sales. Then you've got the debt to assets ratio, which is also a solvency ratio. Remember, this is looking at the company's liabilities, right? So they're 423,500, and it's total assets. So you're saying total liabilities divided by total assets. Remember, there's a difference between the current ratio, which is just the current assets and the current liabilities, to say in the short term, are you able to pay off your debts. This is for long-term's sake, right? Will you be able to pay off your debt? You want this percentage to be as low as possible because you want as little as possible of your assets, to be financed through debt. Because that means if a lot of your assets are financed through debt, you are what we call highly leveraged. So if something goes wrong, as has been happening with companies now in the time of COVID and the lockdown, if you are not generating as much profit as you expected, they end up in bankruptcy, right? Because they realize that they are not going to have enough assets to cover their liabilities in the long term. So this is 41.2%, meaning that 41.2% of our assets are financed through debt. So the other approximately 59 or 58.8% is financed through equity. And then the last ratio is free cash flow, and that information was given to you. You just had to remember the formula. So it's the net cash provided by operating activities minus the capital expenditure minus the dividend, tells you how much cash, in this case $14,000, is actually, as the name implies, free and ready to be used, or if someone's investing in the company, ready to be taken out of the company and not needed for replacement of property, plant, and equipment, or for payments to stockholders. Right, so that's the free cash flow. Remember, that's from chapter 17. The formula is available for you there. So I hope that this exercise at least, gave you some insight into how comfortable you are with calculating these ratios. As I said, sometimes it can seem deceptively simple because it's just, I'll just plug it into a formula, but you do need to practice. So, there is homework that we have for chapter 18. I know everybody is focused on the test right now, which you should be. The test closes on Sunday, but after that, there's the chapter 18 homework that is due on the last day of class, which is June the 4th. So I will check, the next day if people did it. One last time, since I'm not going to see you again before the test closes on Sunday. This is the sheet, the prep sheet for the test and the quiz. It tells you exactly what's coming onto the test. Please remember that there's a full statement of cash flows as the final question, so leave enough time for that. If for whatever reason you, either in this class or some other class, are feeling like you are not going to be successful in the class, please make sure that you speak to your professor. I will have I won't be able to turn it around by the 1st of June, but certainly by the 2nd of June, or even the day when we meet, I'll give everybody their grades to date so that you know where you stand. And if for some reason you feel that you need to withdraw from my class or any other class, remember, first talk to me before you withdraw from my class. But if you need to, the last day to do that is June the 4th. And there won't be any other opportunity to do that afterwards because they've postponed that date right to the end of the semester. Hopefully that won't be the case for anybody. I'm hoping that everybody will just be able to be successful. So that's where we leave it today. If I'm still here for about 12 minutes, if people have questions about anything, you can stick around and ask me. Otherwise, go and have a lovely afternoon, and please be sure not to procrastinate on the quiz and the test so that you can have that in the bag as soon as possible.